All right, let's talk about something we're all trying to do: be smarter with our investments, especially when tax time rolls around. But here's the thing: sometimes a strategy that seems absolutely brilliant on the surface has a really nasty surprise hidden inside. Today, we're going to decode one of the most common tax traps out there for investors: the wash sale rule. I mean, who doesn't, right? It's a massive part of maximizing your returns. And one of the most popular ways to do this involves selling investments that are in the red. But there's a catch. That super smart move can completely backfire if you're not paying attention. See, the IRS has this very specific rule. It's like a tripwire, designed to catch folks who are trying to game the system. And if you trip it, poof, the tax benefit you were counting on can just vanish. So let's start at the beginning. What's the strategy that gets investors into this situation in the first place? It's a very common and totally legal technique called tax loss harvesting. The whole concept is actually pretty simple. Imagine a seesaw. On one side, you have your winning investments, your gains. On the other, you have your losing ones. Tax loss harvesting is just you deciding to strategically sell some of those losers to create a capital loss, which you can then use to cancel out the taxes you'd owe on your gains. And this can make a huge difference. In the US, your losses first cancel out your gains. But if you have more losses than gains, you can then deduct up to this much, $3,000, against your regular income from your job every year. And if you still have losses left over, you can carry them forward to use in future years. It's a pretty powerful tool. But of course, whenever there's a rule, people look for a loophole. And investors quickly figured out a clever trick. They could sell a stock, claim that juicy tax loss, and then just buy the exact same stock right back the next day. They got the tax break, but their long-term investment position didn't really change at all. As you can probably guess, the IRS was not a fan of this little maneuver, so they created a very specific rule to shut that whole game down for good. And this really gets to the heart of why the rule exists. It wasn't about punishing investors. It was all about making sure that when you claim a loss, it's a real economic loss, not just some paper shuffle you do for a day to dodge taxes. So here's the official definition. A wash sale happens when you sell a security at a loss and then buy that same security, or one that the IRS considers substantially identical, like call options on the same stock, within a very specific time frame. The two key phrases to burn into your memory are substantially identical and that 61-day period. Okay, so let's break down what actually triggers this rule. I promise it sounds way more complicated than it actually is once you see the moving parts. It really just boils down to these three simple things. You sell for a loss, you buy something that's basically the same thing, and you do it within that critical time window. If you check all three of those boxes, you've triggered a wash sale. Now, this is the part that trips up almost everyone. The time window is actually a lot bigger than most people think. It's not just about what you do after you sell. So check this out. The full period you need to worry about is a whopping 61 days. It's the 30 days before you sell, the day of the sale itself, and the 30 days after you sell. And that's the sneaky part. You could buy more shares of a stock and then sell your older shares for a loss a week later, and boom, that's a wash sale. To be safe, you just have to wait until at least the 31st day after you sell to buy it back. So let's say it happens, you accidentally trigger a wash sale. What's the big deal? Well, let's look at the financial consequences, because this is where it really stings. Nothing makes this clearer than just putting some hard numbers to it. We're going to compare two scenarios, one where things go right and one where the wash sale rule gets in the way. And wow, you can see the impact right here. On the left, our investor successfully uses a $7,000 loss to cut their $15,000 taxable gain down to just $8,000. That's a huge tax saving. But on the right, because of the wash sale, that $7,000 loss is completely disallowed. The IRS says, nope, they're now on the hook for taxes on the full $15,000 gain. Ouch. This is the question everybody asks at this point. It really feels like the IRS just made $7,000 of your loss just disappear. But hang on, in most cases, there is a silver lining. So, here's the good news. The loss isn't usually erased from existence. Instead, the IRS basically forces you to postpone it. They let you attach it to the new shares you just bought. Here's exactly how that works. Your disallowed loss gets added to what's called the cost basis, the official purchase price of your replacement shares. So if you bought the new shares for $5,000 and had that $7,000 disallowed loss, your new official cost basis is now $12,000. This means when you eventually sell those shares down the road, your taxable gain will look smaller, or your loss will look bigger. You get the benefit back, just later. But, and this is a huge but, you have to be incredibly careful with IRAs. If you sell a stock for a loss in your regular brokerage account and then buy it back within 30 days in your IRA, that's still a wash sale. The loss is still disallowed. But here's the devastating part. Because of how IRAs are structured, you do not get to adjust the cost basis. So that loss, it is gone forever. This is the one scenario where it's truly deleted, not just deferred.
Okay, I know that was a lot to take in, so let's finish up with some clear, actionable strategies you can use to make sure you're using tax loss harvesting the right way without falling into this trap.
Here's your checklist. First, the easiest way. Just wait 31 days before you repurchase. Simple. Second, be careful with those automatic dividend reinvestment plans, or DRIPs. An automatic purchase can trigger this if it's too close to a sale. Third, remember, this rule applies across all your accounts, including your IRA. And finally, you can sell your losing stock and immediately buy something similar but not identical. For example, selling a single tech stock and buying a broad tech ETF instead. And really, that's the bottom line. A truly tax-smart strategy isn't just about finding clever loopholes. It's about understanding the rules of the game. Now that you know how the wash sale rule works, you can finally turn what could be a nasty tax trap into a powerful part of your own financial toolkit.